Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we are going to be taking a look at Chipotle Mexican Grill stock. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you'd like me to take a look at on the channel, just put it down in the comments. I'll get it on the whiteboard. I'll get the ticker up there on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500 like Chipotle is, I post those on YouTube for free. The rest I post over on Patreon, which is $5 a month. And then there's also a free tier over on Patreon too that I've been posting some different thoughts on, like investing books and just general investing topics as well. So the little extra content over there even at the free tier. And then if you're at the $5 tier, I'll post if it uses one of the main strategies that I share here on the YouTube channel, then I post non-S&P 500 stock review or stock analysis there as well. And you can also get a big discount if you join Patreon, if you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha. And those links will all be down in the description. I also have a link for an affiliate link for 25% off of FastGraphs, which is the graphing service that you see me using a lot here on the channel, and I'll use in this video as well. As always, this is not individual investing advice. This is just how I analyze stocks. So with all that, let's get into Chipotle. So I feel like I've always been a little too cautious with Chipotle. I mean, it's in hindsight. I forget when at some point I wrote that I would maybe buy them or something. Right when it was right before the new CEO took over, like a couple days, and I guess it's not new anymore. It's like 2018 or something like that. But it was when they were having some problems with. You can see this big earnings drop back in 2016. Maybe it was like late 2017 or early 2018. Probably right there is my guess. Right before that bump, because I think after that announcement, the stock jumped. And so it was kind of a turnaround potential there, and I usually kind of avoid turnarounds. And it wasn't super cheap still at that point. Like if you look, it had like a 43 PE ratio, maybe even if you assume they were going to grow a little bit. And back during the Great Recession, the PE got down into like under 20. So it still wasn't like super cheap, and that's why I didn't end up buying it. And that was a pretty big opportunity cost. But again, it was never like super duper cheap, and it's not super cheap now, but it's a lot higher. So I'm just gonna take a stab at about when that came out. So yeah, only a 900% gain that I left on the table there, but that will happen sometimes. You can't always predict how well something will do over the long term, especially if they're going through some problems. And honestly, most of this growth really happened after COVID, which is kind of interesting to think about. So if we go to, let's close this down. Yeah, about right here. So going into COVID, this is like pretty interesting. Their earnings still had not recovered to their 2015 levels. So it wasn't like this was I mean, the earnings growth picked up, but they were still just recovering what they had already gained into 2015. So it really wasn't until all the way in 2021, like 5 years later, 4 or 5, we'll call it 4 years later, where earnings finally recovered where they were in 2015, which was like 6 years earlier. So it's not as though it was obvious, I think, that they would be able to grow as much as they have after COVID. And I think we're gonna have to make some assumptions with Chipotle when we try to do a valuation of it. And so all this kind of context, I think, is worth talking about. I'm usually like a numbers first guy and then kind of bigger picture around the edges. But I think with Chipotle, you almost have to look at the bigger picture and think about it as you're kind of looking at the numbers kind of at the same time almost. So before you can kind of try to do any math on the valuation. And this is an important dynamic, I think, because while they were growing well, they really didn't take off until all the stimulus money from COVID, and then, the stock market gains, the housing gains, everything that came post that stimulus. I think really just the upper, third of society has done extraordinarily well. during this time. And then there was a brief period for a year, for about 2 years, where the stimulus money was going to, like the lower half. And so more people had more money for kind of a premium product like Chipotle. I shouldn't even say this because whenever I do, people think I'm like a total rube. But I have never actually eaten at a Chipotle. My wife has, and she says it's really good. But I'm a little bit cheap when it comes to like eating out and things. Like if I would go to like a real restaurant, I think if I was gonna pay that much, and it's not like I work at home, so it's not like I'm going back and forth to work and I eat out, when I'm away from home. I'm not away from home that much. It has to be kind of a like if I go out, I'm off to a destination somewhere else. So that's my excuse for not having checked out Chipotle yet. But it looks delicious, and my wife says it's delicious, and my sister also is a giant fan. So I'll take their word for it, and the public's word, because everybody seems to be willing to pay up for their food. So to the valuation. So I think the big question here is they're growing about 20. They're expected to grow earnings about 20%. That's the assumption that I'm going to use in my valuation. I think that's a generous assumption because I'm going to assume they can do that for 10 more years, which would be just incredible growth. It's hard for me to totally imagine how they might do that, but I mean, it's hard for me to doubt Chipotle's possibilities given what they managed to do so far on the other hand too. So I'm not going to come out with like a super strong opinion one way or another on this one, but I always limit long-term earnings growth expectations to 20% maximum, even if a company's growing much faster than that, because it's just so hard to maintain that 20% growth level over a very long period of time. And if a business goes from, what did they grow the last couple of years? We'll call it 30% in the last couple of years. If they go from 30% growth down to like 15% growth, which would still be fantastic, this PE multiple is probably going to, the stock is going to fall. And it might fall even more than 30%, which is what the earnings growth decline would be. And so when you have a really high valuation like this, when you have earnings growth expectations that are high, the risk of the punishment that comes along with any kind of disappointing news is worse. It's worse than it would otherwise be. So I don't know. Back here they had a 50 PE. Down here toward the bottom, the stock fell 65%. Now that was a weird time, right? I wouldn't expect this sort of decline again. But, if earnings growth goes from 24% this year down to 15% 3 years from now, the stock probably isn't going to go anywhere. Like, it's just not going to make any money. That's most like all other things being equal when it has like a 65 PE. But I am going to give them the benefit of the doubt with that 20% assumed growth rate. And now it looks like they have a stock split coming up. It's kind of nice on Fast Graphs they put this in here. And it looks like it's scheduled for next month, so they must have announced it. I'm not usually a big fan of the stock splits, but when the stock price is like $3,000, I understand it more, because there are people who maybe, if you were going to buy a 1% position in Chipotle, which isn't very big, but that's usually kind of what I use, you would need like a $300,000 portfolio. Most people don't have necessarily have that much money in their retirement account. So you can buy fractional shares in some places now, but there are definitely brokerages where you can't get fractional shares. So in this situation, I think the stock split is fine. It doesn't mean anything to me really in terms of like the valuation. But it's worth noting, if you watch this video a month or so from now, that these numbers, you'll need to like divide them by 50 or whatever, multiply them. Yeah, divide them by 50. Okay, so let's look at the numbers here. I'm going to assume earnings grow 20%. We're looking at a PE right now of about 65. And if my spreadsheet, there we go. Okay, so we have the 20% growth rate. I'm going to assume that earnings grow at the 20% rate. It looks like the PE I'm using is 57. They basically don't have an adjustment for debt. I mean, it's very small. So that comes out to an earnings yield of 1.66. So if you buy the stock for $100 and you own the whole business and you kept all the earnings for yourself, it would only pay you $1.66 a year, or for that first year, on your $100. And what I want to know is how much money could I collect after 10 years at that rate? Now, I assume this $1.66 on your $100 would grow at 20%, so you do get the growth. That's why I have the spreadsheet here. But this is what happens when you have a high PE. So a high PE will mean your earnings yield is low, and that means you're not getting paid very much back on your initial investment, and you really have to count on that growth coming through in order to make the investment worthwhile. So if we do that and we compound that at 20% a year for 10 years, our $100 investment will earn about $51.86. So you start with 100, you end with 151.86 after 10 years. If you put that in a CAGR calculator, it should give you about a 4.27% expected 10-year CAGR on your investment. So that's low. That's very low. And I think 20% is probably going to be generous. So to me, this is definitely overvalued. But if you're a Chipotle, so let's look at this from two different perspectives. If you're looking to buy the stock, aim about 50% lower than where it is right now. So this uses the 2020 drawdown recession data. So if the stock has a similar type of valuation that it had during that sell-off, it would be about 50% lower, just based purely on that 20% earnings growth. In order to get a margin of safety and get this CAGR over 8%, it would need to get down to $1,362. So that's 57% lower. So just roughly, you're looking at somewhere in between like $1,400 and $1,600 per share is kind of where you would have like a margin of safety and be able to get like good returns if they grow at 20%. So it's overvalued. Now, so for me, I would just wait around and see if the market ever gives me a good price, and if it doesn't, then I just find something else to invest in. But if I owned it, if I had been a little more generous with them back in the day, or even after COVID, a person that bought during the trough 2 years ago would be up 150%. So let's say you're one of those people. This is such a high quality business that it's really hard to like totally abandon it. But the valuation's so high. For me, this is one of those situations where I probably just sell half and then commit to holding the other half, like no matter what, basically. Unless earnings go negative, like unless revenues and earnings they're peaking out, the business is old. If you get to that point, that's a different situation. But if you made, over 100% in this stock, now's a good time, I think, to that a person, let's put it this way. If I had bought it, and I was up 150% or so, I would probably sell half and then just completely commit to holding the rest no matter what. So you just ignore it, which is kind of nice. You just put it in I've done this with Netflix and I've done this with AMD, which were purchased kind of at the same time that Chipotle was down. And actually AMD I think came then. No, it was that fall. But I mean, this same kind of dip, I bought those. They've rocketed higher. I've sold half in both of them, and the other half I just am holding for long term. I don't even really look at them anymore. That's probably what I would do. I would do the same thing with Chipotle because they're so strong. They can pass inflation and everything on to their customers. The wealthier customers are still doing really well in the economy. And I don't know how long that's going to last, but there's not any signs yet that the wealthier part of the economy is going to pull back. And it looks like, the Fed and the government and everything is pretty much going to try to do everything they can to make sure that those folks keep spending, at least over the next year or so. So for me, I don't think I'd be inclined to like sell the whole position. I'd probably sell half and then commit to holding the rest long term. And then for those that are waiting for an entry point, about 50% lower from here, which is kind of where I'm aiming if it happened to get down there. chances are if I happen to get down there, this earnings growth rate would be less, but that's what the recession number is here for. So that $1,561 per share is, yeah, I would probably definitely step in and buy if I saw it down there. All right. If you found this useful, hit the subscribe button, hit the like button. If you have any questions, put them in the comments section. If you have a request, put it down in the comments section too. I'll see everybody later. Bye.